descriptions of what the complexities are, but getting something out that meets all the standards that we should meet as a survey by the government is a complex undertaking. And I'm pausing slides. Great. And I should say this is a presentation I'm giving. Doesn't represent as a representative of the Bureau. It doesn't constitute legal interpretation, guidance, or advice of the Bureau, and any opinions are my own. Next slide, please. So what I want to do is give a brief overview of what these surveys are, what they can do, and then give some illustrations of some of the power of the things that we've been able to do with them. And this is only some illustrations. It's from some recent work. But part of what we want to then open up is in the discussion questions to think through what are the exciting things that we can do next, given the power of these surveys. So briefly, there are general financial surveys conducted by the Office of Research. We like to think of them as interdisciplinary, in which we're covering decision-making, perceptions, expectations, subjective well-being, concepts from marketing, and consumer financial products, as well as core economic and financial concepts. I know some of you were here, were at the Boulder Consumer Financial Decision-Making Conference, where I presented some work with Courtney Shoup on thinking through time preferences and their relation to credit bureau data. It's just an illustration of some of the questions that we try to be able to answer. One of the nice things about the survey is that we tend to return to the same consumers more than once. So we get a panel dimension, which lets us think through questions like expectations and other changes. What's really exciting about the surveys is they sample from our consumer credit panel. That's our sample, big sample of credit bureau data, and that's going to allow us to do some really exciting things. At the same point, these are surveys, and they have survey size of between 2,000 and 3,000 respondents, which limits some things that we can say just because we don't have the largest sample size. Next slide, please. So let me talk a little bit about some of the advantages and disadvantages of all of this. So the big advantage there of linking to the consumer credit panel is that we observe respondents' credit decisions over time. So we're going to see in a survey, and then we're going to see, for example, whether you default or whether your credit score goes down or whether you move. And that's going to allow us to give a much richer understanding of what's happening in survey respondents' lives. It also allows us to do better oversampling of target populations. So we start from the consumer credit panel. And so we're able to oversample people who are likely to have financial problems or have medical collections on their reports or complex things like that allow us to think through, have more power about populations that are interesting. On the back end, that allows us to do non-response adjustment that is just superior to basically any other survey you've ever heard of, because we see both respondents and non-respondents credit bureau data. So we're able to adjust for example, our people who might be having financial problems. Well, if they respond less, we're able to adjust for that. Getting that data back helps us complement the CCP because we're observing the credit panel, because we're observing information like race, ethnicity, gender, income that's not in credit bureau data. So it allows us to think through issues that we wouldn't be able to do if we were only looking at credit bureau data. There's a disadvantage. You have to be in the credit bureau data to be sampled. So we're not able to look at people who have no credit record at all. Next slide. So we ask a series of core questions, and I'm going to go through this relatively quickly. Many of them are kind of standard survey questions of the kind of things you want to know if you're asking a survey of someone, and others are a little more general or a little more specific to questions that are important for either policy or broader statutory reasons to the CFPB. So we ask a series of questions on demographics, things like education, family structure, whether you're renting, home ownership. We ask a series of questions that help us define populations that are important to the Bureau, like race and ethnicity, age, low income and credit score, thinking through military service. We're thinking about income and assets and debt, things that, for example, you don't see in the credit bureau data. Next slide. And then we ask a series of questions that help us understand household financial stability and how households are doing, the risks that they might be facing. Questions on financial well-being, questions on whether people are having difficulty paying bills or expenses, questions on household shocks, and what products people are using. And the nice thing about that is we're able to look at products that may not be on the credit bureau data. And I'll talk specifically about buy now, pay later, but things like overdraft, payday, auto title, whether or not you're revolving on a credit card, are all things that, at least in credit bureau data, are really opaque. But you can actually learn a lot about what the entire consumer is doing and decisions they're making in ways that complement the administrative data. And then we have modules that depend on policy needs and current priorities. So recent examples, we had a extensive module on debt collection, and we've been thinking a lot about medical debt recently. Next slide. So let me describe, that's a broad description. Let me talk a little bit about the survey so far, and that'll help us sort of understand kind of what some of the evidence we're talking about. So what we've been doing, we've been moving to an approximately annual rolling panel. When I say approximate, our early surveys weren't quite an annual rolling panel, but I think we've settled into an equilibrium where we're doing a new sample of consumers and returning to the previous year's consumers every year. And that gives us a really nice balance of both new consumers, so we can talk about what's happening across a broad set of new people and address new questions, and people who we've already talked to, and so we can understand what's changed with them. The nice thing about doing an annual rolling panel is it allows us to consistently measure core financial stability and consumer risk questions. So we can think about what's changing across different kinds of consumers who might be having different kinds of problems as those evolve. And then the panel allows us to understand things like persistence and expectations. And finally, there's just a administrative that it turns out that when we return to people who we've already gotten a survey from, they respond much more than people who are sending a new survey to. So we end up being very cost effective to return to previous consumers a second time. Next slide. Finally, having it being annual, having a regular survey really does allow us to be responsive to emerging topics and markets. So I'm going to give you two examples of that, one of which I'll talk about fairly extensively. But I think one of them is just really important. During the pandemic, we were somewhat surprisingly, we've been in the field in 2019. We had a survey that was going out in May 2020, and we managed to get another survey out to the same people in February 2021. And so that allowed us to get a really deep insight into individual consumers' financial lives during what was a really complex period. And Courtney Shoup and I wrote that up in Consumer Finances during the pandemic, in the Bureau's big report on what happened during the pandemic. And I pulled many of those things into a book that I published last year from Princeton University Press, The Pandemic Paradox. It also allows us to think through big changes that occur. So to give an example, buy now, pay later is an emerging product area with possible consumer risks. Student loans have similar issues. The evidence on the problems of renting and eviction have been changing and have encouraged us to think through, well, what can we learn? And then there are older issues like payday, where many of our data sources are incomplete. And so being able to collect regular information and understand how these markets might be changing helps us be responsive to evolving markets. Next slide. So I'm going to talk a little bit about, give you some examples from some recent work we've done. From several different pieces to give you sort of a range of the things that we can do. So the first is the report that we just published this morning, which we're really excited about. It's our Making Ends Meet in 2023 report, and that's our yearly State of the Consumer flagship report. So it's the Bureau's closest thing, the Bureau's statement of what we think is going on with consumers, at least as of the date of the survey, and we try to bring that as close as we can using our credit bureau data. I'm going to talk about a topic report that Courtney, Greta Lee, and I wrote on buy now, pay later, which we were able to use the link to the credit bureau data to say some really cool things about what was happening within that market. And then I'll talk about some research that Dave Lowe and I have done on expense shocks and trying to size the importance of what happens when people face expense shocks. Next slide. So these results are out. They are now public, which is exciting. We were unsure about that was going to happen. So I'll show you a series of survey measures. And what we've been finding consistently, and this happened to some extent last year, and now we're now the trends are pretty clear, is that we've really seen a return to the pre-pandemic level of financial well-being and other measures of difficulties across a range of measures. The timing of the different bars is really important here. So we're going from June 2019, which was our first survey, to February 2021, which is the third wave of and with a new sample that we did, and then going to a regular annual rolling sample in January 2022 and January 2023. So just as you keep in mind that these aren't they aren't quite set up as a full time series; they're just set up as the bars for those time series. But what you can see is there was a big bump in financial well-being, a big drop in difficulty paying bills in between June 2019 and February 2021. But by January 2022, some of that had disappeared. And we didn't ask a key question that we would have liked to on the February 2021 survey on whether or not you could cover expenses for more than a month if you lost your main source of income. But across these measures, what you see is there was a big bump early in the during the pandemic. And what we've now returned to is where things look pretty similar to where they were before. Difficulty paying bills or expenses has been increasing. It's not quite to the place where it was before. In June 2019, 40% of households reported having difficulty paying bills or expenses in the previous year. In January 2023, 37.8% reported having difficulty paying bills or expenses. And I should say, because there are economists and other social scientists in the room, we do report the standard errors in our report. We try to be careful about that, but they get a little messy once you start adding things in. And finally, we've had a real increase in the increase in the fraction who say they could cover expenses for a month or less. I believe that should be could not. Next slide, please. So, partly indicating that we can actually do confidence intervals. One of the things that has been concerning to us, and we've seen this to some extent last year, and we're wondering whether this is going to be a continuing trend, was what we thought was an increase in income variability over the last several years. So just to give an indication, and the confidence intervals are important here because whether these are significant differences depends on the confidence intervals. We saw a big drop in people who were saying that their income was about the same every month from before the pandemic to about January 2022, which seems to have somewhat reverted. Just to give a sense about that this was also a time when many people were moving jobs. And so in many ways, this is partly understanding the different ways in which people are adapting. Income variability can be bad, but it can also be good as you get to a new job. And so understanding what's happening with consumers is an important part of what we'd like to be able to do. Next slide. So this is one of the things that we then try to be able to do is, because we collect all these demographics, to be able to think through what's happening that's different across demographic groups. So I'm really just going to focus here on the leftmost column, and what I want to take away is that the percent with difficulty in paying bills or expenses, which in some ways is a really good summary measure of somebody had a real problem in the past year that their finances weren't able to cover, that either their liquidity wasn't there or they had a big expense which they couldn't cover, but they had a big high marginal utility financial event. Overall, in 2023, 37 or 38 rounded percent of families say that they had one. But looking at the differences across race, for example, 55% of African-American respondents who are African-American and say that their households had difficulty paying bills or expenses, compared to 34% of non-Hispanic white households. These things vary, as one would expect, really tremendously across income groups. So just understanding the large differences that exist in our economy are really important for us understanding where there are problems and emerging risks. Before I move on, I want to just talk very briefly about the last one, student debt status. So we observe people's credit bureau data, and an important part is that people who have who currently have student loan debt are about 10 percentage points more likely in January 2023 to say they had difficulty paying bills than the year before. And just to be clear, January 2023 is before federal student loans resumed payments or resumed required payments last month or 2 months ago now. Next slide. I'm going to talk a little bit about what we can learn by linking to the credit bureau data, because I think that illustrates some of the power of what we can do. So buy now, pay later, is a emerging area of emerging product. It's being used much more commonly. It was almost non-existent in 2019, and has become much more prevalent since then. So just a good way of thinking about this is we're charting people's credit score over time. We don't have a clean difference in difference. We asked whether people in the survey were using buy now, pay later in the last year, but they really couldn't have been using buy now, pay later before 2019 or in 2019, just because it wasn't widely in the market. So what we're showing are the credit scores going back in time of people who reported in the January 2022 survey whether they had used buy now, pay later in the past year. So this is just a difference, and you can take two things from it. And in fact, headlines took two exactly opposite conclusions from it. Both of which are true, but it depends on what you want to focus on. So the first is that people who use buy now, pay later have lower credit scores. And we go on and show that they have higher delinquencies and are in more financial distress than other consumers. That's just, you can tell they have different credit scores. That's what the lines are. But, and here's the key thing that looking to the credit bureau data lets us do, that was true before buy now, pay later existed. So people who are choosing to use buy now, pay later have lower credit scores and are more likely to have delinquencies, at least up through January 2022, admitting the kind of what we can see in the survey. It doesn't appear that buy now, pay later caused that difference, because they also had lower credit scores before buy now, pay later existed, was widespread in the market. And so some of the advantages of being able to do that kind of difference in difference are which is, and this is just to be clear, not a strong difference in difference. It's a really help us think through, well, where are there likely to be problems and who is likely to be having those problems? Next slide. One of the things I think was surprising to us, and I think given some of the narratives, it turns out buy now, pay later users are actually very heavy credit users. They are much more likely to have a credit card, or 13 percentage points more likely to have a credit card than non-buy now, pay later users. They are also much more likely to have delinquencies. So a good way to thinking about buy now, pay later users, at least as of the year up to January 2022, was that many of them did have access to credit and were choosing to use buy now, pay later as part of one of the things that they were using. Sometimes, perhaps, because it could be less expensive. Next slide. Okay, so I'm going to switch gears a little bit and talk a little bit about expenses. And this is going to connect to several lines of work that I know some of you are doing. And so part of the reason why we thought this would be useful is it would illustrate some of the power of things that we can do. So first, the surveys have always been really concerned with understanding household shocks and just measuring the extent of what shocks people have, how frequent they are, and how those are related to difficulties. More recently, we've started measuring the size of shocks. And the value of doing this in a survey is that you really need a survey to distinguish shocks, particularly expenditures, from planned expenditures, because in some senses the intention matters here. So I'm going to be leaning really heavily on two questions, and I'm using the two just to give to compare them. In one, we're going to ask, in the past 12 months, has your household experienced a significant unexpected expense from any of the following? And that will include things like a major out-of-pocket moving expense, a vehicle repair, moving costs, legal fees, taxes or fines, medical expenses. And if yes, about how much was the cost? I'll compare that to a different question. In the past 12 months, has your household experienced a significant drop in income from any of the following, and a series of different pieces? And if yes, how much the cost? And I want to emphasize significant drop in income. There's a little bit of asymmetry here, which is intentional because it matches the expenses, but is also limits in other ways. Next slide. So this graph shows a distribution of the percent of income lost to all expenses, all income drops, from the making ends meet, or calculated the same income drop from the PSID when we could do it annually. And we want to be a little careful about what we can learn from the income drops, but the reason we're showing both the income drops, making ends meet, and the PSID is just we want to show that we're kind of getting somewhat comparable things. So I want to emphasize 3 different pieces from this. The first is that expense shocks are very common. 70% of households are going to have one. But a lot of households are going to have a fairly minor one. Just an example, I broke my phone last year. I was running, I fell, the screen shattered, it was dead, I had to get a new one. That's an expense shock. I would have preferred not to have broken my phone. But was it a big deal? No, probably not. I mean, I would have been in the 10% column. But a significantly important fraction of households have very large expense shocks. And there are different ways to measure that, but if you want to think about sort of 50, 60, 70% of income lost to expense shocks end up being quite large. In what we're doing, we try to understand that, and what ends up happening is that there are lots of different kinds of expense shocks that can all be large. Medical expenses are certainly one of them, but medical expenses are only one of the large shocks that can be important. Your car can break down, or can get broken. Your house can have large repairs. You might have large legal fees, all of which can both happen, but they can also happen at the same time. And so that pushes bad things out into the tails. So our evidence is pretty clear that out in the tails, which are what matter if you're thinking about insurance or credit or default or bankruptcy or evictions or lots of different things, out in the tails, it's really expense shocks that are really the kind of key thing. Next slide. One way to show how that matters, which I think helps illustrate some things that I think, for example, Dean is thinking about very carefully, is to ask who is getting large expense shocks. So what we do look at is their Vantage score, their credit score in the year before the survey takes place. So the survey is asking what happened in the past year. We're looking at a year before the survey takes place. Now, I want to be clear, that's not solving all endogeneity problems, but at least it's meaning that endogeneity isn't mechanical of you had an expense shock and you couldn't pay a bill and your credit score went down. It's at least looking before that happened. And what we find is striking that both income drops and unexpected expenses are just a lot more common for people with lower credit scores before those things occurred. What was perhaps surprising to us is that expense shocks are more common for lower credit score people, but income drops are actually a lot more common, which we had not expected to be the difference. These same kind of gradients occur across income, as just income level as well, adjusting for the income drop that we're seeing. So next slide. So what we wanted to do is then ask a series of questions to our ARC members. Of course, they can bring up their own to help us understand where we should be going with the survey and what are our exciting things that we can be doing. So we want to think about both what are the policy things that we can be doing, but also get your perspective on academic research. We just released our yearly report. We'd really like to have that be a focal point for for both the academic, policy, and media community be thinking about understanding household financial stability and how it's changing. Do you have advice on how that could happen? What should we be measuring? We're measuring a lot of things. Survey space is always scarce. We have limited ability to talk to our respondents and ask them questions because they are willing to give us their time, and we really appreciate that. But that means we need to be very careful about how much we put in front of them. How can the surveys better meet academic needs? And finally, kind of a broader question, we've got this administrative data match. That's really exciting. But in some ways, it's almost, it's hard to even kind of figure out what the cool thing that we should be doing with the administrative data match. And so how can we use this powerful structure to answer important questions?
All right, well, thank you, Scott. Now we're just going to turn to the ARC people on the panel, and I guess I'll start on my left.
Thank you very much, Dean, and thank you, Scott, for that report. I do have a question that I wanted to ask about. So I've been paying a lot of attention lately to demographic trends in the United States, and some of the data is suggesting that we're hitting a tipping point where 50% of the US population could be above the age of 60. And certainly as those individuals live longer and longer lives and we see lifespans increasing, that's going to just continue to grow as a percentage of the population. One of the things I've always found interesting back when the CFPB was developing the financial well-being scale, it showed up in that early data that older consumers, older Americans, tended to actually score higher on financial well-being, which of course is a subjective measure. And I see some of that even in the data here, that the greater than age 61 group has a pretty low percent of difficulty paying bills. So from a subjective perspective and from a lot of these measures, those older Americans seem to be doing okay. But here's what I'm kind of curious about. We've got a generation now that is going to have just as many years in retirement as they had working years during their careers. And as they progress through those 30 or 40 years of retirement, how does the making ends meet type questions, things like default, how does that change as they age? And especially the unexpected expenses. They don't have dependable income anymore, other than perhaps Social Security or other kinds of retirement income to really compensate when unexpected expenses hit. And so trying to figure out their financial fragility or stability is something that I think you have amazing data here to already begin looking at that, but then also tracking it over time would be really interesting.
Thank you. I think those are exciting things. And maybe just to sort of thinking through subjective and objective, I want to be a little cautious about that, but I mean, kind of both. Did you have a difficulty, sort of a question that's a little more directed at sort of something that you could perhaps measure objectively, but then the link to the credit bureau data of something where it's administratively sort of, and those things don't have to be the same, right. And can evolve differently, and that's interesting in its own way.
I guess let me start by saying thank you, Scott and Eric, for your hard work on this and putting together a fantastic report, which I plan to read on my flight back. The connecting survey and credit bureau data, I think, is additive relative to our knowledge base and sort of provides, I think, a great opportunity for academic research and for sort of policy relevant research. I'll touch on two things which I think operate at this intersection. The first is, I know there was a bullet on shopping behavior, but I think digging more into how consumers shop and for different consumer financial products and how shopping behavior varies across consumers with different demographic characteristics, I think is very important. For markets to work, consumers need to be elastic to the prices and quality attributes of different products. And I think our understanding of the type of shopping consumers do before they take out a product, and we can see product take up in the credit bureau data, is an area where we have limited visibility. So learning more, I think, would be useful. The second thing I'll touch on is I think the way I think about credit reports and credit scores is they are balancing a trade-off between, on the one hand, we want lenders to have information so that markets don't unravel from asymmetric information. On the other hand, if you default on a loan because of bad luck or a mistake, that information can sort of drag down your access to credit for 7 or even 10 years with a bankruptcy. And so, having information on your credit report sort of exposes you to previous mistakes. So sort of when information is reported, there's a trade-off between market functioning and sort of the insurance you get from information being removed. And I think there's academic research that tries to get at this, but I think something that can be done with the survey is to understand people's private information. So before they take out a loan, do they have expectations about their future income or future expense shocks or default risk that the sort of purpose of credit scores would be able to sort of shine a light on, or do they have limited information, in which case there's sort of limited risk of unraveling, and things like the removal of medical debt can sort of be a quality enhancing because they are no longer sort of punishing people for bad luck of having medical expenses.
Without being too much, Ava Nudgeball and I have the answer to that. We posted it this spring, but kind of a large scale removal of information, and can think through the equity issue, both the equilibrium and pooling effects, and because we see actually the large scale removal. But agree that we can think through expectations really matter here, and what people expect to do.
Okay, so I was very remiss in my job. So the first person who asked questions was Suzanne Hsu from Cornell. The second was Neil Mahoney from Stanford, and now Abby Sussman from Chicago Booth.
Hi, so yeah, thank you also for putting together this amazing survey with so much interesting and important data in it. I think that the questions that I have are mostly around money management strategies and how people are trying to cope with these various shocks that they have. And so I think this can fall into a few different categories. One question is around how people are able to plan and save for anticipated shocks. Another related question there is whether people's expectations map onto both, I guess, in terms of shocks that they're getting, but also when people, for example, if you're taking out a credit card and you anticipate that you'll be able to repay, how costly are those mispredictions if, let's say, you end up revolving debt where you expected that you would be? You have a good answer to that.
I'm sorry. I'm very smiling. I think we will have an answer for you not in June, but we're really excited to think we work with some of our credit card markets people, and we're really excited to actually think through exactly many of those exact like what do you expect to pay back your credit card bill next year, and we're going to be able to think through. Well, okay, how many people is that a surprise? I don't know. How many people is that a surprise for that they didn't? So I apologize to being. I'm just really excited that I love it when we anticipate smart people asking the right questions, because what we're always trying to do is think 12 months from now, what's going to be the question that we're going to want to have answered, because that's sort of the survey lag time. Apologies.
Hey, no, not apologies. Thank you. That's amazing. And then I guess sort of two other questions also around this money management. One is, when you think about measuring expense shocks in the survey data that you presented, you were talking about these sort of tail shocks. One question that I have is that people may not be properly aggregating some of the smaller shocks that they have throughout the year. And so if you have, your cell phone breaks and then you get a parking ticket, and these smaller shocks may be something that people, in terms of reporting in the survey, might have a harder time doing. So it might be worth thinking about different ways of asking the question to potentially trigger recall around multiple of these sort of smaller exceptional events that might add up across the year and actually be more costly to people than they realize. And then the last question that I have is around the gig economy and whether people are, in certain cases, able to make up for some lost income by taking on extra sort of hourly type of work.
Briefly, that's one of the things that we were, we do think that there's one of the things that sort of the survey has done fairly well over the last several years is, so for example, when we asked, did you have a difficulty paying bill or expenses? Then we asked her, what did you do? It turns out that looking for more income is actually a fairly common thing, as is defaulting on some other bill, not paying something, sort of that there's a lot of endogenous response, which is, I think, really complicated, but I think we're excited to think through those questions. Thank you.
Okay, the next person is Ben Keyes from the Wharton School.
Yeah, thanks so much. And Scott, this is, and Eric, this is great work. Just to piggyback on some other comments that have already been raised, Suzanne mentioned demographics and age. The number that jumped out at me the most was the large increase in the oldest age group in terms of financial difficulties, 8 percentage point increase relative to basically no change for that youngest group. That jumped out as a surprise over this past year. And so I think that kind of speaks to this theme of what's going on with a population where we think incomes are relatively stable or predictable. Expenses are oftentimes more stable or predictable. So what's changing in thinking about their budget? To Neil's point on the value of adding the survey to credit records, what credit records are accounting for are quantities of debt and really not prices of debt. And so I think this shopping piece is really important. And to the extent that you can get more information on how much people are paying, because I think of this mapping to the Fed's financial obligation ratio or something like that in terms of how much of your outlay is towards, say, paying interest on a variety of debts. We're in a higher interest rate world, so we might be worried that something like a financial obligation ratio would be going up. That's measured at a national level based on aggregate measures. This might be a way to trace out a distribution of those underlying elements. And then finally, as we're thinking about the kind of holy grail of the academic research that we all do, it's trying to paint the most complete picture of the household's finances. And I think, this is taking an important step in that direction. And so thinking about where some of the gaps are in terms of the data collection efforts, I mean, you can kind of rattle off categories of income, expenses, assets, debts, consumption, expectations, and preferences. We can keep going to that list, but maybe that's a top line list. And so as we're thinking about the kinds of research questions that are out there, usually 1, 2, or 6 of those 7 things are missing from our data. And so thinking about the extent of those missing objects of interest and how this survey can fill those in a more systematic way might be a way to brainstorm where to fill in some of the gaps.
Could I pose a question partly because we've got a broad, if you have good ways of asking about prices that a consumer can understand on a survey in a succinct way, I would love to sort of, which is to both acknowledge that prices really matter, but also to acknowledge that sort of we've had a hard time figuring out how to ask them in just something we need to put in front of a consumer without, And I'm partly asking because we've got sort of people from different disciplines here, and you can tell me offline if you have ideas, but just thinking about how to actually do that, would be really valuable to us.
I'll just add one I'm not going to answer that question. I will just add very briefly that there are certain contracts that are a fixed duration where you can back out what the interest rate is. And so, duration isn't available in the credit record either. For the most part. And so, even just asking people about, hey, how long is that auto loan that you took out? That might be a way to back out the interest rate in ways that they don't necessarily need to know the exact rate. If you know what their monthly payments are, you can figure it out from the amortization schedule. But there are certainly other survey questions out there for asking more specifically about credit card interest rates and things like that.
Okay, the next person is Vinaba Ado from University of North Carolina.
Hi, thank you. I also cannot answer that question about the prices, but I do have some comments or I guess suggestions. I was also thinking about aging and demographics, and one thing that came to mind was questions around whether or not who expenses are being paid for. So beyond just the individual. We think about a lot the family structure, parent to child, but also now we have upstream transfers. So adult children to aging parents might be something, and also aging parents paying for their children and grandchildren. And so those complexities of expenses. I also was thinking about if there was any, or you could collect or ask about whether or not people are using or making more riskier or dangerous decisions with regard to the services or expenses that they're using because they can't meet those expenses. So are they driving their cars longer or can't, change their exhaust or, whatever scenario comes up. But what are you capturing women prior to the unexpected expense I was thinking about? So how much risk people are placing themselves in because they can't meet the expense. My last thought was around costs associated with kind of interacting with some of these services. So this is along the question from like a policy perspective. Like, are people avoiding or interacting with some of these, I guess, places where they have to make these purchases or even just interacting with public services? I was thinking a lot about like the administrative burden literature. I'm not sure if you're familiar with that, and how tech has probably made things either easier or harder and reduced some of the costs associated with those. So I'll stop there.
Okay, and finally, Katja Sain from Yale University.
Always good to go last. Thanks for the great presentation. I guess I had two reactions that I was wondering about. The first one is there's the nice panel aspect to the survey that I don't know to what extent that's been exploited. And I think it'd be useful for a number of directions. One, just sort of, there's like these financial well-being measures, some of whom seem more objective or subjective. And I was wondering whether, for example, together with the credit history data, you could learn something about what that really actually captures, how that evolves over time, how it responds to shocks in people's credit reports, and just to give a little more context for what really it is that we're measuring, which I think would be useful. And then, the second area that I thought was really interesting, sort of banking off what other people have said, is just sort of who tends to buy and use these new financial ways of paying. Like, for example, this buy now, pay later, what does it substitute with? I was actually quite surprised that it seemed like you found it doesn't expand credit, which I think is surprising. And so I think it's sort of good to understand why that is. And is that because of the types of products people buy using these measures, or is it because of the types of people who use it, and how do they learn about these products? So I think there's sort of interesting questions around why that doesn't seem to expand how much debt people take on, that I think would be more broadly interesting for newer products like this, and who they compete with.
Question, the buy now, pay later, is that the technical term for like layaway plans? Is that kind of what we're thinking about here? Because
that is a great question. Okay. It actually goes directly to kind of the complexities of surveying. So buy now, pay later is a term kind of used in the industry, and typically what it means is a payment plan with 4 or fewer payments and no interest. And those are very specific things, because if you have more than 4 or if you pay interest, there are some regulatory things that sort of apply. And so if you're under 4 and have no interest, so that's the term we're using. The reason I'm saying that's so complicated is, well, buy now, pay later can describe a mortgage, can describe a credit card, can describe an auto loan. And so being clear to consumers that we mean this thing, not all of those other things, was something we thought really hard about, because again, it's not a product that everybody has used. And so that term, but that's what we mean by it. The product can be larger.
And you kept, I was equating it to like a layaway plan, and you kept saying this new product, and I was like, that's been around for years.
And you're right, layaway plans have been around for years. What we mean is the newer thing, but making that distinction is important and hard, and we think very carefully and do cognitive testing, try to put it in front of consumers and find out how badly we failed the first time when we asked the question about what they were thinking about when they were answering the question. But it's a great question.
I guess I'll just finish up with a couple things. So I just have always had this trouble with trying to think of what does it really mean, household well-being. And so I do think what you're getting at is very important. Maybe the first thing that people think about is, oh, let's kind of check out a person's credit score. And, but we know that, credit scores are based on models that use repayment data and things like that. And that don't have all the other data that you have. And so I know I'm going back to this stuff that Alexandrov, Brown, and Jane did, but showing that there's lots of other things like assets, liquidity, that actually help predict a person's likelihood of delinquency and things like that. I think Eva is doing new work on that. I think that's really, really critical. I just want to also go down and kind of say what Neil was saying about information problems and the nature of shocks. I think that's really, because if it's just bad luck, there should be insurance against that. But if you make your bad luck, that's a moral hazard problem. Maybe there shouldn't be insurance against that. So anything you can kind of do to disentangle, and I'm just echoing what other people have said, the nature of moral hazard or adverse selection in people's decision making, that would be really, really important. And then finally, this is something we were talking a little bit about at lunch, but how much can you survey people about their insurance policies? Because it seems like, that's another, like medical insurance policies, just other forms of insurance policies that would be, it's a substitute for those assets that we're talking about, building up assets versus other products. That would be a kind of an interesting thing to do.
We certainly ask about insurance, how detailed one can get, again, on a survey where you have to be kind of, the more you want them to draw distinctions, the more complicated you get, and it's harder to ask questions that are going to be really leading. But we ask, do you have health insurance? Does everybody in your family have health insurance? Things like that, just sort of to get a baseline of how much are you insured against some things. But maybe we should be doing more, understanding, yeah.
Just the different types of products might, in a more general way, might be good. So, we have like 5 minutes left, I think. Does anybody else want to kind of now, we could go around a second time.
I just wanted to follow up because Katya, I think, made a really good point about the panel nature of the survey. And Scott, I didn't know if you wanted to talk about how we've used that in Buy Now, Pay Later and in your book. And
no, thank you. That's so we have actually, the panel is exciting, and in some ways sort of one of the hard parts that Eric Wilson and I have been really sort of struggling with is how to combine an administrative data with a panel, with a survey panel, and what you can do with one, and kind of how they can complement each other, and kind of, we think there's sort of more cool stuff to do. We have been trying to do some things like that with it. So just to give an example of some markets where this really matters, we've done some reports on alternative financial services. And the key thing about, for example, payday, for example, is we want to understand, okay, maybe if this is a one-time thing, that helps us understand its use. If it's a sort of repeated thing, and we're able to look at things across, say, payday, auto loans, and pawn loans using the panel. And you need the panel because you don't see these in credit bureau data, and actually show that there's a whole lot of repetition. People who are taking out the loan one year are also going to be taking it out for the most part in a second year. And so that helps us just like that panel is really valuable in that sense. The other way that the panel is really nice is you actually get to see the individual and see how they evolve. So as Jason brought up in the book I wrote, one of the things that I did was actually look individually at people who were experiencing different kinds of things to kind of illustrate what was going on in their life, what was going on during this really tumultuous time. So I think it drives home the point that at the end of the day, we want to understand people, and those people are going to be unique in their own ways. One of the people I profile, Sophia, somebody had died and she'd had a big expense because of that. And so she didn't have any money left over. And then she lost her job in March 2020. And so they missed a mortgage payment, and we can see that in the credit panel. And things looked like they were really spiraling, and understanding her evolution over the next year is something you have to do in a panel. You wouldn't get per evolution, you just get the average if you didn't have the panel. But thank you for the prompt, Jason. There's more that could be done, and it's really exciting to think through what more could be done.
And so just a quick follow-on question. How long does somebody stay in the panel?
So during the pandemic, because it was weird, we did a 3-piece panel. We've sort of standardized into a rolling annual sort of one. So we go back to you a second time the next year. I think that balance is sort of attrition versus sort of what you can learn from the panel. There are clearly things you can learn from a longer panel, but that requires a different kind of approach to the person, a different kind of relationship that I think we can really establish. If you have different opinions on maybe we should be doing it more or even less frequently, or we should go back to them 6 months later or 2 years later, but we sort of feel like the yearly is a good balance, was sort of our thought on it.
I mean, I guess I thought the balance should be something around how much recall do I still have of what happened to me in the year before and since then, right? And so that seems like a reasonable idea to me. It limits a little bit, I think, sort of what you can do with this, but the survey isn't that big, so I think that seems pretty reasonable to me.
So can I just say one last, because one of the things you ask is how can the making ends meet surveys better meet academic research needs? It would be wonderful if there's somehow to make data in a very, in a form that doesn't require issues associated with, privacy available to academics. I mean, this morning Neil was using simulated method moments. If you have just a nice average moment that doesn't, involve people, just if there was some way, I think it would get used so much. And so we talked about that. I mean, it would be nice if we could all get to that data.
If we have 1 second, I'll mention one thing which connects to, I think, Ben's terrific comment about in credit bureau data, we see quantities, but not prices. And we also don't see fees, which are a large share of revenue for many financial products. For some healthcare surveys, to increase data quality, the surveyors will get hard information from medical records, from medical providers, and thinking about piloting, there's a way to get survey respondents to take a photo with their cell phone of a mortgage statement or a credit card statement or something else that then can be, so OCR, you can use computer techniques to turn that into data. If, over, a period of time, that becomes a way to collect high quality, hard information, that would obviously be a huge lift, but would also be hugely valuable.
Okay, so I guess we're exactly at 2 o'clock. So we're going to take a 15-minute break and resume in 2:15.
Yeah, a big problem with mine. I feel that like the big brother problem. And so, but it's just like, we don't have space in this time. The actor much as well. The audio is often here, but the video is just and the yeah. Are we gonna call that? Yes. I'll call on. Yes. And know that we're Right, so it would be not just like say, say something. Yeah.
and comments on the previous paper, so I'm going to pass it over to Zahi.
Yes. Hi. Can you hear me okay? Yeah. Good. So I'm Zahi Ben David from, we call it the Ohio State University. So I apologize for not being able to be there. I was planned to be there, but I couldn't. Anyway, I wanted to congratulate Scott and on the survey. I had a couple of quick questions that I wanted to just raise and see whether maybe they're interesting. So the first one is about shopping for credit. So just to understand better, what's the opportunity set for individuals to find, to shop for a good deal? How much do they shop? I mean, do they perceive? I mean, are there search costs or perceived search costs involved? The second point that I had was about trust in the financial system. And I was wondering whether we could add to the existing academic research about which institutions are perceived as more trustworthy. Is financial advice, whose financial advice people trust? I guess these are the two main issues that I wanted to add, and maybe they help. Thank you so much.
Thank you so much, and we're sorry for your recent loss, maybe I should say. Although I think there are some members in the room who are on the opposite side of that divide. Sorry for there was a big game this past weekend. Just I feel like that was not.
We just
okay.
We weren't there on Thanksgiving.
Yes. Yes, but I recognize that may not be universally felt. So very briefly, kind of, in some ways, actually, it's delightful to have Suzanne back with us after an IPA. Suzanne actually helped us think through some early shopping questions. They've evolved. I don't think we have the same ones on but we do like to think through. It's always hard to ask a consumer what they know, because in some senses there's a little bit of implication maybe you don't know some things, and so sort of asking in a non-leading way is something we think very hard about. But we've had a series of questions sometimes that we think are more successful, and we haven't done as much with them as maybe we could. And I think we're also very interested in trust. Trust has been something that sort of is really hard, because you want to think through kind of how to ask it again in a non-judgmental way. I will admit that the early pilot, I think, had trust in various institutions, including the banks and the media, and some. I think we felt like some of those questions were maybe a little too leading, but we wanted to sort of be able to think through particularly how different communities might approach their choices about finance because of their understanding of and what they believed as their trust in financial institutions and other institutions. But we look forward to hearing more about kind of how you would think about those.
Yeah, we could continue offline. I mean, but these are very interesting directions, I think.
All right, thank you. So we're next going to shift our agenda to medical debt, and we're joined by Bureau subject matter experts from the Office of Research. They include Tavi Carrere, Supervisory Economist, Office of Research, and Ryan Sandler, Senior Economist, Office of Research.
Thank you very much, Dean. Can you hear me? All right, so if you could put the slides on. So this is a very brief introduction to medical debt research at CFPB. I'll talk a little bit about the work that we've done in related to medical collections, medical debt. And then I'll turn it to my colleague, Ryan. But before I get started, we have a disclaimer. Seems like this is a different disclaimer than Scott used, but the views expressed here are those of the authors and do not necessarily reflect those of the Consumer Financial Protection Bureau or the United States. Next slide, please. So medical debt is an area of continued interest for the Consumer Financial Protection Bureau, in large part because CFPB regulates credit reporting and debt collection and has taken a strong interest in the reporting and collecting of medical debt. Our research work has leveraged various sources of information. I'll talk about the CCP, the Consumer Complaint Database, and some other sources of data that we have. So in terms of the Consumer Credit Panel, or its successor, the Consumer Credit Information Panel, and the Making Ends Meet survey that Scott talked quite a bit about. We looked at how changes in medical collection reporting affected consumers. There have been a few waves of changes in the way medical collections were being reported. The last one in April this year removed all paid collections from reporting and extended the delay for reporting from 180 days to a year. Ryan's going to say quite a bit more about that. But we looked both prospectively in work that Ali Brown and Eric Wilson did on what the effect of these changes might be, and also retrospectively in work that Ryan and Zach have done. We looked at using CCP at medical collections and consumer finances in rural Appalachia. And I think the most important finding there is that the rate at which consumers have medical collections is quite a bit higher than other rural areas of the country. I think the numbers are 24% in Appalachia versus about 17% in other rural areas of the US. So we tried to get an understanding of what might be going on in those areas that face perhaps distinct challenges from other rural areas. And then we looked at required financial assistance for charity care and its effect on medical debt as we see it through the prism of medical collections. Susan, Eric, and I did a blog in which we use Making Ends Meet data to actually show that of people who very likely are eligible to receive charity care or required financial assistance, about 40% have medical collections. And this was using an earlier wave of Making Ends Meet. That is perhaps concerning, and it just shows that perhaps not all the people who are eligible to receive required financial assistance do in fact receive that assistance. Then we looked at the information contained in the Consumer Complaint Database that the CFPB has. Our colleagues in consumer reporting had a medical billing and collections report as described in the consumer reports. The consumer complaints. And then in one report that we did recently on medical credit cards and financing plans, we looked at complaints specifically related to this topic. Next slide, please. We also leveraged, and perhaps we'll do this in the future as well, the information that we acquired through market monitoring authority. One of the reports that we did on medical credit cards and financing plans looked at the information that we collected from credit card providers on products with deferred interest. There were a few concerning items in our findings. We found that between 2018 and 2020, people paid about $1 billion in interest on these products. They paid interest rates that are significantly higher than for general purpose credit cards. And I'll stop here just to give Ryan enough time to present his work with Zach. But if you want to learn more about our work, there's a landing page on medical debt on the CFPB main page. So thank you. Ryan.
Thanks, Tavi. If we can go to the next slide. Title, of course, the disclaimer Tavi gave earlier applies to me as well. All these opinions are mine and my co-author, Zach Blizzard. So this is material, I guess a preliminary look at material that I hope will be out in a report sometime in the next few months, though currently it's not otherwise public. This is looking at, as Tavi alluded to, there have been changes in how medical collections are reported. So we can go to the next slide. We'll kind of get into the material. Oh, that's not how I remember that slide looking before. Sure. So shouldn't be any surprise here. The use of medical collections on credit reports is somewhat controversial. There's this notion that medical collections are not consumers' fault, which you can think of in a couple senses. One, that as Neil and others were talking about earlier, like if you just have bad luck and get sick, that's not really saying anything about your financial ability. But also just because medical billing in this country is so messy, it can be the case that you genuinely are not responsible for a bill, or genuinely just didn't understand that you needed to pay a bill, and nonetheless it can wind up in collections because insurance doesn't pay it timely, or because you had 5 bills and you paid 4 of them and thought you were done, or whatever the case. So in part in response to the concern over this, the credit bureaus have changed how they handle medical collections over time. The NCAP, which is National Consumer Assistance Plan, which was their branding of their response to a big lawsuit from State's Attorney General. One among the other changes that they made in response to that is they started not reporting medical collections until they were at least 180 days past due. This is back in 2017. They also forced all furnishers of medical collections to actually, really all furnishers of collections, period, to actually say what type of debt it was. There was always a field for that, or was for many years before, but around a quarter of actual collections trade lines just wouldn't have it reported. And so starting in 2017, they're all reported and all the medical collections have to be 180 days past due. Later, they announced in March of last year that they would remove more medical collections. As of July 2022, they were going to take off all paid collections and all collections that were now less than a year past due. In addition, they announced that in early 2023, turned out to be April, actually kind of March, as I'll show you, they were going to take off all collections worth less than $500 in the initial balance. So back in July of last year, I put out a report with another colleague, Lucas Naif, who's no longer at the Bureau, analyzing what we thought was going to happen based on what collections we could see that were paid, what collections we could see that were less than $500, how that was likely to be distributed. As I think someone mentioned, I think Tavi was mentioning that our colleague Eric Wilson, along with Ali Brown, had a report earlier this year just about what generally happens to consumers' outcomes when medical collections fall off of their credit reports, which, as I'll get to in the results here, happens a lot. So if we can go to the next slide. In this presentation, I'm going to show you some updates to that July 2022 report to describe what has happened since March of 2022. since that was as far as we went in the report last year. And this is all, I forgot to put his name on the slides, this is all using data from our consumer credit panel, which is a sample of anonymized credit records from one of the three nationwide credit bureaus. So what we find, as we expected from the report last year, in fact, lots of medical collections fell off. That's not terribly surprising, but it was a bit more than we forecast, and I'll explain why that happened later. We do find that these changes disproportionately affected older Americans, mostly in good ways. They were disproportionately had the kinds of collections that turned out to fall off. But we do find some sort of disproportionality across the population, both in terms of census tract characteristics and across states in different parts of the country, in terms of who still has collections hanging around and who managed to get them all removed. So I think the rest of the talk is all tables and graphs, so we'll just go through these results. So if we can go to the next slide, please. There we go. So on this slide, we're just showing the characteristics of people who had medical collections at 3 points in time. In the first column, it's people who had medical collections in March of 2022. So this is before any changes. It's just the normal people who had medical collections. Then in December 2022, these are people who if they had medical collections that were less than a year old or were paid, those are now gone. And then in June 2023, as far as we go, at least in this report in the data, this is after everything's happened. So the population is changing, and of course the population is shrinking. So we in terms of our samples, about 1 in 48 of all Americans, so you could roughly multiply by 48 if you wanted to know the whole number in the population. But the number of consumers with medical collections on their credit records falls by more than half. The remaining people live in lower median income census tracts. They are more likely to live in they live in whiter and census tracts. They are less likely to have other credit. They have lower credit scores on average. This isn't that the credit scores of the people with medical collections are falling. It's that the people who have them, who still have medical collections after all the changes, happen to be people with lower credit scores. In fact, probably their credit scores on average are going up, but that's a whole other can of worms. So we can go to the next slide. So this is just showing, going much further back than just 2022, the trend in medical collection, the share of consumers who have at least one medical collection on their credit record. And in the July report, we had this, I think maybe going further back, but ending at March 2022. So this is just kind of continuing that trend line. So one thing that's worth noting is that medical collections have been dropping off of credit records for a long time. Back in 2018, there was around 17% of consumers had a medical collection on their credit record. By March of 2022, we were getting down around 14%, 13 or 14%. There is a dip, or what looks like a dip, in June of 2022, which is before we maybe should have been seeing anything, because the change really was supposed to happen in July 2022. The trend continues for a few quarters, and then in March 2023 and June 2023, it kind of falls off a cliff, and a bunch more fall off, which is about what we expected. As you would have seen in the previous slide, before the changes, about 2/3 of individual medical collections trade lines, I think that's it, were less than 500. Maybe 2/3 of consumers had something like that. Anyway, a bunch of the medical collections, a large fraction of them were less than $500. So unsurprisingly, you take them off, a bunch of your people have them. To give a sense, there's sort of two things going on here. One is that this is hiding a decent amount of churn. And I also just want to demonstrate that the dip in 22, which is mostly going to be from those relatively new medical collections. Only about 2% of all medical collections are ever marked as paid prior to these changes where they got removed entirely. So most of this decline cannot possibly be from paid medical collections. So if we go to the next slide, this is showing in any given quarter, what share of the people who had medical collections last quarter have no medical collections at all this quarter. So one thing worth noting is that the amount of churn quarter to quarter is huge, right? It's between 5 to 10% of everybody with a medical collection has no more the following quarter. They're all falling off for those people, which is consistent with what we found in the report last year, where we showed that over a year or 15 months, around half of all individual collections trade lines would drop off of people's credit reports, which is not the way it's supposed to work. In theory, these collections items can stay on as negative information until up to 7 years past due, but they're not mostly. I still find this really just nuts, because if I told you that 5% of everyone with a credit card in any given quarter has no credit cards the next quarter on their credit reports, you would think, okay, this is hopeless. We can't track credit cards. But here's what we have. So we do see that June 2022, when paid but mostly newer medical collections trade lines were falling off, that was an unusual amount of people not having medical collections anymore. So that is actually a drop. Something happened there. It's not just that, you look at a slightly bumpy trend line, you can kind of infer any functional form you want. But in fact, something happened there. And then indeed, March of 2023 and June of 2023, a third or so of the remaining consumers with medical collections in each of those quarters fell off. Combined, that ends up like a third, and then a third of 2/3 ends up being about half in total have no more medical collections. So that's sort of the overall trend. Now I want to talk a bit about the distributional impacts here. So if we can go to the next slide. This is showing the share of people in different age groups that had a medical collection in March of 2022 before any changes, and the share that still had them in June of 2023. So for everybody, it's going down. That's good. Everybody's benefiting to some extent. If you go in percentage terms, though, the older Americans, who admittedly had fewer medical collections, a smaller share of them had medical collections on their credit records in the first place. But they have more than 2/3 of those people have all of their medical collections removed, whereas it gets less than 2/3 for the other age groups. And this is not entirely surprising. Previous work by our colleague at the Bureau, Krista Gibbs, and some of her external co-authors showed that older Americans, particularly those over the Medicaid age, tend to be more likely to have these low balance medical collections in the first place, and they're likely due to copays related to Medicaid. So we can go to the next slide. So this is showing the distribution of consumers in the CCP overall, and consumers who had medical collections or medical collections removed across different census tract characteristics. So this is as a share of all consumers, where do people in these different categories live? So the first column of all CCP consumers is just giving you a sense of, okay, what is the distribution of people who live in majority Black or Hispanic census tracts, or who live in different median income census tracts, of everyone with a credit record. The population of people who had medical collections in March of 2022, before any of the changes, was typically more likely to live in majority Black census tracts, more likely to live in low-income census tracts. And that's still, compared to the overall population, that is still true of the people who remain with medical collections in June of 2023, or the ones. But the people who have all medical collections removed, relative to people with medical collections in the first place, so are more likely to live in higher income census tracts and more likely to live in majority white census tracts compared to people who still had medical collections remaining. But that said, it is a small difference compared to the overall difference between people with medical collections and people without. So don't want to oversell that result. So one more result I want to show you, if we can go to the next slide, is how this varies across the country in different places. So the top two maps, the top left shows you the share of consumers in each state who had a medical collection, at least one, prior to the changes, so in March 2022. And the right shows the balances per consumer, not quite balances per capita, because it's balances per CCP person, which is a person with a credit record in our sample. And then the bottom maps show the same statistics, but in June of 2023. So of course, balances go down per person. The share of people with credit record or with medical collections on their credit records goes down. But it varies a lot what's left between states. And you get some really extreme things, particularly on balances. It's hard to see with the maps. We're not getting the exact numbers. But one thing we have in a draft report is that whereas like Nevada, the balances per person only go down by about, I think it's 7%, whereas in neighboring Utah, it goes down by like 80 or 90%. On average, balances are only falling by about a third. I think it's 38% nationwide. So a lot of the medical collections balances haven't gone anywhere. A majority are still there, even as the individual medical collections items have fallen off, and the share of people with those medical collections has dropped. So that's all of our results, and I'll now go to some discussion questions. If we can go to the next slide. So as with Scott, I'll just read off the questions and you guys can respond to whichever ones you want. So one question is, how should we monitor medical debt now that we are now not seeing nearly as much of it on consumer credit records? And maybe a corollary question has been big on my mind. Should we ever have been monitoring medical debt by looking at medical collections on credit records? In addition to the churn issues that I've mentioned, there's the issue that anybody who looks at this stuff is only looking at one credit bureau, typically. Credit bureaus, medical collections are typically not reported to all the credit bureaus. So we're always getting a weird picture. And of course, we're only getting this rolling picture of whoever happens to have medical collections in any given period. As we go on into the future, so far our CCP only goes so much further after these changes were fully in effect in April. What outcomes should we be looking at for these people where medical collections dropped off? And then finally, this question that Dean teased at the start of the meeting, the big concern from industry stakeholders is these sort of unintended consequences that people won't pay their medical bills if it's not going to show up on their credit records. But of course, credit reporting started out primarily as a way for lenders to address asymmetric information in the form of adverse selections. I only want to make loans to people who are going to pay them back. It's not really intended, or wasn't originally intended, to induce people to pay them back. They just wanted to know, ex ante. So to what extent are medical collections specifically, and credit reporting more broadly, serving as a deterrent to moral hazard, so inducing people to pay things back, as opposed to reducing information asymmetries for creditors so they know sort of who's a good credit risk? And with that, I will turn it over to the ARC for your views.
Okay, so since I have 2 strikes and I don't want 3 strikes, I'm going to turn to Zahi Ben David from the Ohio State University.
All right, thank you so much. So as you were kind of wondering about whether we should record a medical debt, I was thinking to myself that much of the way that the credit register works in the US is very different than the way it works in other countries. So at least in some countries that I'm familiar with, in Europe, they collect unpaid TV licensing bills and parking tickets that are unpaid. So in a way, these are all somewhat arbitrary decisions made at some point, and we're all born in this, into this system, and not always questioning what should actually be there, or what should optimally be on this credit register, and what it serves. For example, one could make a case for having part of your assets also on the credit register. It's not only about whether you missed a payment because the bill was stuck in your mailbox. Maybe some sort of assets should be there. So it's just what struck me as you were describing the results. Thank you.
Thanks. I've been having a very similar thought about that lately, and perhaps what makes me particularly extra super special, this is definitely just my opinions, not those of the Bureau, but it's not just that it's arbitrary of which medical collections actually get reported, it's a little bit arbitrary that it's medical collections specifically that get reported. As we were talking about in the Making Ends Meet session, there are lots of expenditure shocks out there that probably determine whether somebody's going to be able to pay their bills. If you have an auto expense, that's going to be a problem. But auto expenses aren't in the credit register. Why are we arbitrarily just having this random subset of medical collections?
Okay, so we're going to move in the opposite direction this time. So I'm going to begin with Katya Same from Yale.
All right. I have very little input on any of these questions directly. I will just say, I think the way you presented it, Ryan, I think you think yourself that maybe trade lines are not a good measure. And what I didn't get a very good sense of from your presentation is why you think the churn is so high in trade lines.
So we know a little bit about this from our markets colleagues who follow the debt collection market closely. One of the things is probably partly coming from another provision in NCAP, which is that medical collections that haven't been updated in at least 6 months are purged. And it's alarmingly common practice that a medical debt furnisher will report the collection and then just leave it there and never do anything with it again. So the information is quickly stale. In general, collections furnishing, I've been working with the collection specifically data for most of my time at the Bureau, is just very badly done. I don't think creditors would use credit record data if credit card furnishers reported trade lines as badly as medical or as collectors do. So it's shoddy reporting, I think, was really it. It's that, and the other partial aspect is a pay for delete phenomenon. So one reason probably that we only see 2% of collections ever paid is that typically what will happen is a consumer will, they'll apply for credit, they've got a medical collection, they get denied, or they see that they check their credit report first, and then they go call up the debt collector and they say, hey, can we settle this? And they settle it, and then the debt collector removes it. But again, then it's begging the question, like, what kind of information is this giving creditors when what you only see is the people who haven't called up the debt collector to remove it, right?
Yeah.
So I don't have so many input pieces on the other questions. I did want to say, though, it's not on the question, but I think the question of medical credit cards and how competition in that space works, I think is really interesting and important. And I think it'd be worth understanding how these companies compete and who they recruit and how they target, because I think the stats that you had were quite shocking.
So I think, speaking for myself, I think that's a really good point. If you look generally credit cards, you think, oh, maybe that industry is not that concentrated. But perhaps if you look at the subset of people who use medical credit cards, these products are not very good substitutes. So maybe it's a distinct market. And that distinct market probably doesn't have as many players as for general purpose credit cards. So maybe the fact that the interest rates are quite a bit higher for medical credit cards is flowing from that observation.
Okay. The next person is Finaba Ado from UNC Chapel Hill.
I guess I don't have much to add. I was wondering, from my limited knowledge of this topic, I know some work has shown that like debt collectors disproportionately go after certain demographics and in different groups. So with this information removed, we're losing information into markets that are kind of replicating inequality, especially in the credit space. So I would be interested in how might we still be able to get those kinds of that information in other ways of how some demographic groups, racial groups are disproportionately affected or impacted by these services. I don't know if that makes sense.
So once again, we point back to the Making Ends Meet survey where in fact, one of the Bureau's pre-Making Ends Meet first surveys off of the CCP was asking consumers about their experiences with debt collection. And we had some further questions based on that in one of the waves of maybe multiple waves of the Making Ends Meet survey.
Our 2020, so our 2023 survey, the one we just that we have the full data back from.
Perfect. So yes, the survey data is a good way to go with that. And the other troubling aspect of collections on credit reports is that it's a weird segment even of the debt collection market that ends up as specifically collections trade lines. Because the way that this data works is that a collections trade line, specifically a third-party debt collector who's either working on contingency or maybe is a debt buyer and they bought the debt for less than face value, they are reporting themselves, this is a thing that the consumer needs to pay, as opposed to like a credit card company saying, okay, this debt is now in collections. And it's still the same account as when you were paying it and charging on it, but now they're saying, okay, well, the current status is now that it isn't paid. So most credit cards in particular, the original creditor keeps furnishing themselves. They do not have their collectors furnish for them. And so the collection, despite the fact that credit cards are a big part of the debt collection market, they're a very, very small portion of what we see as collections trade lines. And so collections trade lines, at least until recently, were primarily medical, utilities and telecommunications, and then a small percentage of other stuff. So it's an odd space, debt collections on credit reports.
It sounds like it's a space where bias can enter.
Yeah.
Yeah, the next person is Ben Keys from Wharton.
Yeah, thanks so much, Tavi. And Ryan, I think on this medical credit card issue, I was going to raise the same point that Katya did, which is, if we think about medical debt generally, usually relative to a lot of other consumer credit, it doesn't have a high revolving interest rate attached to it or penalty fees attached to it in quite the same ways. And this is why, if you think of the usual pecking order in which people pay off their debts, they may be more reluctant to pay off medical debt rather than others. And so I'm very curious to know why some individuals would choose to finance medical expenses through a high-cost credit card relative to the alternative, which might be to not make the payment at all or to delay making the payment. So what's the benefit to sort of using a medical credit card relative to the traditional alternatives? I think the other piece that came out of this is that collection records are not equal to debt, and do we care that much about, from a policy standpoint, about these small dollar amounts outstanding? So less than $500 of Medicare copays outstanding doesn't seem like the kind of thing that we think about as a crisis of lack of medical insurance in this country or the cost of insurance in this country. So that long upper tail matters quite a bit more for thinking about policy. And so getting back to actual measures of debt seems really important. This seems like a big measurement problem that is only exacerbated by taking these off of the record. And so we need some other source. And I think that just comes back to this first question of where to get that, and whether that's coming from surveys or coming back to this hard information point that Neil raised, if we can get people to share their bills in some way that's more direct, or share these collectors' direct information. And then the last thing I was going to mention is geography. So the maps that were shown were very interesting, and they tie into some work that Neil and I were doing on sort of the importance of place in trying to understand some of the heterogeneity in outstanding collections balances, and whether this is coming from sort of, you could think of the different players in this space, whether it's the local hospital network, whether it's the debt collectors who operate in that market, or whether it's the people in that market that are driving some of that geographic heterogeneity. And that seems like it might be worth further diving into.
Did you want to respond?
I don't think there's anything. That's all great points.
Addie Sussman from Chicago Booth.
Thank you guys so much for putting together, also again, just another really important presentation. I guess two questions. One is the second question around sort of what outcomes should the Bureau focus on, and that seems to come back to this pricing, right? So the purpose of the credit report presumably is to help companies price. And so is there any way to get visibility into whether this is actually helping the people who have the low interest, the low dollar value debts removed?
I think we might be, that is a really good point. We might be able to get at that, as I think Ben was mentioning earlier. If you know the term and you know their monthly payment and a couple other things, you can back out rate. And you definitely can do that in our consumer credit panel with auto loans. You can do it with mortgages to a point. Credit cards, not so much. Of course, credit cards, like whether the interest rate is actually a good measure of the cost is a whole other can of worms. But yeah, no, that's a really good point.
And then in terms of this moral hazard, I mean, one question is, do consumers have any idea of the role that medical debt plays in their credit score in the first place? And I think that's something my guess would be not, but you could also do a sort of small scale survey to figure out whether people have any understanding of how that works in the first place. And if not, then it's unlikely to have a very big impact.
That is also a really good idea. Thank you.
Okay, the next person is Neil Mahoney from Stanford.
So thank you, Tavi and Ryan, for a super interesting presentation. I guess a couple comments which relate to your questions. On measuring medical debt moving forward, I think what we saw on credit reports was never a perfect measure. It will become a even less perfect measure over time. I think that sort of increases the case for working with other agencies in government to put the pieces of the puzzle together. So I'm particularly thinking about Treasury IRS with their 501R authority to collect information from nonprofit hospitals and the extent to which CMS can get information from hospitals that provide Medicare and Medicaid services on the amount of debt they are trying to collect, the number of people, characteristics of those people. I think, sort of need different agencies to lock arms and use their various authority to understand this situation more comprehensively. On your third point about sort of pay for removal and moral hazard, I guess the corollary here is if hospitals and medical providers think that there will be lower recovery rates on medical debt, then they have a incentive to more aggressively market medical credit cards, and for market forces, may come up with other ways to just sort of try and monetize these unpaid bills. So I think being aware that the market will respond and thinking through whether those responses are things we want as a society, I think is sort of a topic to track moving forward.
Again, very, very good points. I mean, and worth noting that I don't think this was in any of our slides, but it is public information. I think it was in the discussion outline. Beyond the voluntary changes made by the credit bureaus, the Bureau has announced that it is considering, not proposing, but considering, a proposal to remove all or prohibit the inclusion of medical collections on credit reports entirely. So that it is highly relevant at the moment of what we're going to do and what further removal might do to healthcare providers and others going forward.
Okay, and the last person is Suzanne Shu from Cornell.
Thank you, and thank you, Tavi and Ryan, for a great presentation. I think, so I've done some reading on the third-party debt collection industry, and that is an interesting industry. And I think from just a policy perspective and some of the moral hazard and deterrent questions that you're asking, I'm relatively convinced, both from that reading and learning how tracking of information happens in that industry and what you're seeing and the issues you've brought up. I personally am comfortable with the fact that the trade lines probably weren't a good indication of debt and that this is a good direction to be going. But I did have a few suggestions or comments. So one question you were wondering is, how should the Bureau be trying to understand what's going on with medical debt and medical debt collectors? And Tavi, I think you mentioned in the first few slides the complaint helpline that the Bureau runs and using some of the data from that. And I know you guys didn't present anything on that, but I think that's an interesting thing to keep tracking and see whether consumers are calling in with comments about collectors and what the volume of those calls looks like. And then the other piece I was going to mention on the third one, I agree absolutely with Abby that I think it's worth a study, a small scale study to understand what consumers are thinking about. And I think the way I would, this is my data survey design hat that I'm putting on, the way I would structure such a survey would be to borrow an approach that previous ARC member Eric Johnson from Columbia uses, which is called query theory, where you just ask people what, imagine that you get called by a collector, third-party collector for a medical debt. What are the things that come to mind? And you just start writing those down, and then you have individuals go back and self-code those. Does it have to do with credit score, or does it have to do with other things? And again, my reading of the literature on that industry is that a lot of it is just the stress of getting a call from a collector who's threatening you in multiple ways. And the credit score is probably not top of mind, but I think that's an empirical question that is worth finding out. Thanks.
Yeah, excellent points again. Thank you.
Okay, so I guess I'll just finalize things. And I think these are things that have been said before, but as a big picture question, is it good or is it bad? Because there are costs and trade-offs in what everybody's saying. I mean, it drops off. I think you had said in your paper that for the 500, your credit score would go up by 21 points or something like that. All right.
Was that? Oh, this is from the report last year.
Yeah.
Yes. Just as a empirical fact, on average, the quarter after people's medical collections go away, it's 21 points. Sounds right.
So all of a sudden, these people, I'm pretty sure I have a bad memory, so it might somewhere over there. So all of a sudden, people are pooled, right? And so then the question, I mean, we're always trained to think more information is better, but kind of in a third best world, it's not clear that more information is better. So these are kind of big questions that it would be really nice to have an answer to. I don't know whether that means how you actually go about doing that, whether you write down some form of a model to be able to assess welfare. I don't know. Because I totally agree with everyone that, once the pooling starts going up, you could get some rationing going on. You could get higher prices. It would be interesting to have some sense of what the costs and benefits are a little bit more than, or going forward.
Yeah, my view on this has sort of been driven by these recent results on the amount of churn, which is not something I had entirely understood before digging into this data. If it were the fact that, like a bankruptcy, these things appeared and then stuck around for 7 years, and it was a matter of, it's not really how these things are getting used. It's getting used as it appears. For some people, it stays around for a while, and for some, it stays around just for a couple months. And some of them, it gets reported once, and they never update it, and then it gets purged according to the credit bureau's rules. And so it's not clear. It's even. I feel like maybe we're already in a pooling equilibrium. We just don't realize it, because there's already lots of people with medical debts that don't have medical collections on their credit reports, either because it's not reported to the credit bureau that the creditor happens to be looking at, or it isn't a year old yet, or, whatever the thing is. There's a bunch of reasons. I think there's other estimates from others in the literature, like 30% of Americans have medical debts. But even before any of these changes happened, there was only like 10% of people still had them. Maybe it's 14, but before any of the changes. So most of the people with medical debt don't have a medical collection. And which people have a medical collection from one quarter to another is not consistent. And so, is this even giving a very good picture to creditors who are trying to make decisions based on medical debt? Is that actually giving them useful information? And I think you might actually improve the information quality that creditors have by taking these things off. Is at least my provisional view based on working with these data.
All right. So we're actually at time. We're actually past time. Some of us have to go and catch flights and things like that. So first of all, thank you very much, everyone, for a great afternoon filled with your perspectives on these important topics. I think a unified theme of these presentations is the question of what we need to add or subtract from existing traditional credit scoring models, which affect household access to credit, housing, jobs, et cetera. So for instance, we've been kind of talking about that when subtracting data like the medical debt, we potentially get more pooling and unintended cross-subsidization of risk. Can adding data, goes back to kind of the first one and other studies here, like asset measures of liquidity, help incentivize people to build up buffers and separate good from bad risks. And then finally, surveys which try to disentangle the nature of hard to observe shocks to households, you know, because that's what you were kind of asking, what is the nature of the shocks? You know, it's kind of critical to complement the observable data, and that can help us avoid unintended consequences of which disincentivize good behavior. So this has been, I thought this was a great 2 papers and a great conference, and want to thank everybody again. And with that, I'm going to turn it over to Jason.
I don't have much to add other than just to express my gratitude to the members of the ARC and to my colleagues for participating today, and look forward to future conversations. I think with that, we can end the meeting. Thank you.
Thank you so much.